Good afternoon, everyone, and welcome to the latest of Smith Novak's NPL webinar series. This one is titled The Irish NPL Market: How will Irish banks deal with an increase in non-performing loans post-COVID? I would like to thank our lead sponsors, Mason Hayes & Curran, and sponsor Dillon Eustace for supporting this event today. Both Mason Hayes & Curran and Dillon Eustace are leading Irish law firms who have been involved in all aspects of the Irish NPL market from the time of the global financial crisis. In addition, Mason Hayes & Curran will provide a report supporting this called the Irish NPL Market 2021. You come to us in Dublin, where everyone is a bit happier today as our government announced a road path out of our current lockdown. As our vaccination programme is being rolled out, I do hope it is the last full-scale lockdown we've had to endure. However, as the lockdown is released, the unprecedented and very welcome financial support the state and ultimately taxpayers have provided will have to be unwound. How and when this occurs will have a significant impact on the NPL, loan sale and loan securitisation market here. My name is Luke Charlton and I'm a partner at EY with the privilege of leading our strategy and transactions business in the island of Ireland. For my day job, I'm a turnaround and restructuring strategy partner at EY and a licensed insolvency practitioner. So I deal with all aspects of businesses in distress, either acting for debtors or creditors or other stakeholders depending on the situation. I'm really lucky to be joined by an esteemed panel today who will share their insights and perspectives for you. I'm sure many of you know them, but I will start by introducing each person. From our lead sponsor, we have Mason Hayes & Curran. I'm joined by Neil Campbell, a partner in Mason Hayes & Curran's financial services team. Neil has worked on many of the large-scale loan portfolio trades over the last number of years. He's acted for local institutions in the context of their deleveraging programs and with funds on acquiring NPL portfolios and subsequent workout strategies for those NPLs. Next, we have Jamie Burke from NAMA. Jamie is head of strategy and communications there. NAMA was the first government-sponsored AMC set up during the global financial crisis and has successfully achieved its aim of an orderly deleveraging of its NPLs. Jamie was there from the beginning and was closely involved in many of the loan sale trades NAMA undertook. From LCM Partners, I'm delighted to be joined by Declan Reid. Declan has worked in both the private and public sector and as an advisor and investor in the NPL and performing loan space. LCM Partners is one of Europe's leading alternative investment management firms and responsible for managing over 30 billion of assets across many portfolios and has completed a number of trades in the Irish market. From a loan owning and servicing perspective, I'm pleased to be joined by Brendan Keogh, Managing Director of Everyday Finance. Everyday is the largest and most established credit management business here, and Brendan will bring his insights into the current market risks that loan owners face in Ireland. Lastly, but no means least, I'm joined by Keith Robinson from our sponsors Dillon Eustace. Keith is a banking and capital markets partner at Dillon Eustace. Keith advises on a broad range of Irish international financing transactions, including loan sales and acquisitions and securitizations. He has advised on asset disposals for banks and other institutions in Ireland in connection with their deleveraging strategies and has advised purchasers on loan acquisitions. So the big thank you to Mason Hayes & Curran and Dillon Eustace. I'll proceed to the panel to ask their views as we go forward. I would say there is a chat function, so please feel free to send questions through the panel and I'll endeavour to work them into the conversation. So maybe Neil, if I kick off and ask you first, what's your current view of the market activity that you're seeing in Ireland at present?
Okay, just firstly say a big thank you to Smith Novak for putting on a dedicated Irish event. I think we must be very lucky to have a dedicated NPL event in Ireland. Obviously, we're very happy to support today's webinar. Maybe look, turning to your question, I think you're probably going to have to park COVID for a minute and look at the loan sale market pre-pandemic, and then look at it in the context of what's happening in the Irish banking space at the minute that everybody be familiar with. I think pre-pandemic, it was a developing market, probably not a mature market, nowhere near as mature as say the UK, but I think there was a good appetite for Irish NPLs from investors, and I think that remains the case. On the deleveraging space, I think the financial institutions have to be credited with huge effort in deleveraging their NPL ratios over the last 5 or 6 years. It's been a fantastic effort. The one caveat I'd say there is that there's still work to be done. And the trick that we have, or the difficulty that we have now, is that deleveraging still needs to happen. But we've had a couple of big announcements in the Irish banking space in the last couple of months from Ulster Bank and KBC. I think their exits, they're not surprising, but I think the timing of them is pretty surprising and got us all maybe a wee bit off our guard. I think if I can summarize the current state as, particularly if you look at it from a pure NPL space, I think the current announcement is going to have a kind of an unintended consequence of kind of stymieing the NPL market at the minute. Like, what I mean by that is that the big sellers of Irish NPLs have been the financial institutions. And they're now, many of them are now committed to the acquisition of portfolios. And as anybody watching this knows, transaction teams on sell side, buy side, or even on the finance side are small. They can only focus on a certain number of deals at once. So I think that's going to be very tricky to see how the NPLs, particularly in the Ulster Bank and the KBC side, get unwound. And then also how the other Irish banks deal with their own deleveraging requirements that still need to go ahead. I won't go into the reasons for the departures for KBC and Ulster Bank. I think they're well documented, but I would say that hopefully it'll be a trigger for maybe a review of the capital adequacy requirements, maybe a look at how the risk weighting assets criteria is applied in the Irish banks, and maybe there might be an opportunity in that space for the remaining Irish banks going forward. Maybe if I looking at COVID, I don't know what's going to happen in relation to NPLs coming out of COVID more than anybody else. I think the big question is when will the supports be lifted? How will they be lifted? Certainly, we think retail and leisure and all the sectors that are under pressure at the minute will remain problematic. Probably an opportunity for consolidation there, and probably an opportunity for investors for distressed debt investing as distinct from maybe NPL acquisitions. Probably, in summary, a lot of uncertainty. But in my experience from I do a lot of NPL trades, my experience would tell me that uncertainty generally creates opportunity in the market for investors. That'd be my summary.
Thanks, Keith. And sorry, Neil. And Keith, are you seeing similar trends to what Neil is, or is there anything different between the loan trade or securitization aspects of the market?
No, but just to kind of carry on from Neil, I think there's just been a number of kind of interesting things in terms of market commentary. So, like a number of the rating agencies, where they're taking a kind of more macroeconomic look around kind of the status of Ireland, what's happening, the levels of NPLs in their portfolios and the bank's portfolios, are effectively of the view that the return to performing payments following payment breaks kind of at the end of February has been pretty high, with kind of around 85% of borrowers returning to pre-COVID payment terms, which is obviously encouraging. I think the other elements that Neil touched on as well, like there's been a fairly significant adverse impact on hospitality and retail, which everybody knows about. So I think in terms of where the market is going to go, there's probably going to be an increased level of NPL activity in the commercial real estate space, and particularly in hospitality and retail. I think the level of distress due to kind of central bank policies over the last number of years in kind of households and buy-to-let space is probably not going to be as severe, because asset values typically have kind of held up in a way that they didn't in 2008. So I think probably the underlying fundamentals of the market are probably much stronger than they were in 2008, but it's going to be a lot more sectoral in terms of how the NPL kind of market will shake out once the kind of pandemic has settled down and we're back to a more steady state. In terms of securitization and other developments in the market more generally from a kind of legal regulatory perspective, I mean, on the 9th of April, changes came into the securitization regulation to facilitate NPL transactions being dealt with by way of securitizations. The original securitization regulation kind of made it very difficult for pure NPL portfolios to be brought to market for a number of reasons, including kind of disclosure requirements and due diligence, risk retention, and so forth. So I think the environment to facilitate a more fluid NPL market is developing, which is helpful. But again, the empirical research on a European-wide basis versus, for example, what happens in the US, for example, is that the uptake of securitization as a method of resolving kind of NPL arrangements isn't at the same level in Europe, and it's kind of developing quite slowly. But I mean, I think there's a bit of work to be done on the securitization regulation still. I still think the bar is too high to facilitate a large uptake of securitization structures as a methodology of resolving kind of NPL portfolios, but I think it's kind of moving in that direction. And my expectation is that probably by the end of this year, kind of given market pressure, there'll probably be more of a focus to try and amend the securitization regulation even further to facilitate more securitizations in the NPL space. So I'll hand back to you, Luke.
Thanks, Keith. And Declan, building on that, what are you seeing in Ireland that may be different to other aspects of the markets that you see across Europe?
Yeah, I suppose just building on what Neil was saying a little earlier on, I think pre-COVID, we saw Ireland entering kind of the later stages of recovery from the global financial crisis, where the last remaining kind of portfolios of size were being prepared or were coming to market in the form, and in Ireland that means non-performing mortgages, which have typically been the most difficult to resolve. And we've seen a relatively healthy turnover of secondary portfolios, tail sales, strategy optimization decisions by the early purchasers from NAMA and IBRC. So there is a flow of kind of assets coming out of those previous large purchases. And I think in the anticipation to the end of kind of the last of the jumbo sales, we and lenders begin to plan for through the cycle management of NPLs, and that's the more steady state approach to NPL management, forward flow arrangements, the stability of the servicing providers in the market. We even saw recently the proposed combination between Pepper and BCM, the old Link Asset Services, which ultimately didn't proceed, but was a clear sign to me that with an expectation that volumes would be declining, there'd be a drive for efficiency in the servicing market. However, COVID has had an impact and has shelved some of the preparation and execution of those planned sales, probably pushed them back by 18 to 24 months. And we'll see the lenders, AIB was able to get away 2 mortgage books kind of late COVID. We have other lenders who are preparing books to bring to market in the near future, but it'll be interesting to see how, as COVID impacts emerge, how it impacts those plans. So I think the NPL market's going to remain active. We obviously have 2 large withdrawals, which will create opportunity. We also have seen some new entrants, some late cycle entrants who, similar to other markets, where we've seen late cycle entrants come in, maybe with a lack of local experience, and can disrupt pricing, but often will ultimately lead to opportunity. So as those entrants kind of adjust to the new volume that's coming to the market through COVID and the withdrawals, it'll be an interesting time, and I think we will see some opportunity, both in terms of participating in those and seeing how these new entrants kind of manage their way through their original pricing decisions.
Thanks, Declan. And a neat link to Brendan in terms of what you're seeing from your perspective, and how the workout strategies and the activity that might come and how they interlink, in your view.
Yeah, I think generally in terms of the market, I think I would certainly agree with all the views so far. I think, as Neil said, there's a lot done, more to do. I expect that on the primary sales side, there's definitely more trades to come to market, probably around the more difficult type assets, the non-performing owner-occupied market in particular, I'd suggest. There is a very interesting secondary market opening up, as Declan was alluding to there, suggesting. So that'll be interesting, and I think there's a lot more activity in that as we advance. COVID-wise, it's very early. It's too early to call it. We certainly know that the Central Bank of Ireland's moratoriums, extensions, they ended at the end of March. So I think we're into a critical period now, and it's very much how the government are going to manage and time the reopening of the economy on a phased basis, coupled with the government supports, because definitely that has kept the arrears levels quite low or suppressed up to now, the government supports that have been available. So it'll be interesting to see how that happens. I think there's some good positive news, as you said, Luke, today from the Irish government, and I know they're certainly making some announcements later on this afternoon as well in terms of that reopening. So signals are it's not going to be a cliff edge. It'll be a slow reopening. But I think one of the key items to remember here as well is that there is a build-up of revenue debt on top of the normal debt that's in the marketplace. That's going to be critical for small businesses and how they cope with that going forward.
Yeah, no, agreed. And Jamie, I know obviously NAMA's firmly in the tail of its original book, you know, and there's talk at European levels of different AMCs and stuff. You know, what sort of role do you see government institutions may have or in the market, depending on how it moves forward?
Maybe just to touch on that, I suppose, like obviously we're all aware that the Europeans are talking around this asset management companies at a national or at a pan-European level, or also this network of national asset management companies. Like in terms of a systemic solution to a potentially trying to make sure that they are prepared as best they can, I think something that is a key lesson from the last crisis. I think Europe was definitely caught off guard in 2008, 2009, and had a very much a piecemeal solution in the early years. NAMA, as you've mentioned, was one of the first AMCs. So I think it's useful. I'm not so sure that it's a top priority from a European perspective. I think before any solutions looked at, even from an Irish perspective at an AMC, I think banks will be afforded more time and space to deal with any pending NPLs. I don't really see an AMC at a national level coming anytime soon. I think that is the right way. I think banks have learned how to deal with NPLs in an Irish context. I see the Irish financial institutions dealing with NPLs that may arise from COVID, again, probably as part of the first wave of resolutions across Europe. I think just focusing on an AMC, I think it really will come down to the scale of the problem and the systemic nature of the problem. To that extent, I think that we also have to look at the structuring of AMCs, and one of the key lessons is really around the funding of an AMC. I'm not so sure there's political appetite or any other sort of appetite at this stage to endure any more bank bailouts or nationalizations. So I think we will have to look at a different funding mechanism. So it'll probably be a mixture of private and public funding of an AMC. Just to maybe add, like from an Irish perspective, I don't really see there being any evidence of any real need for much planning at this stage for an Irish AMC. Like the economy has obviously proven a lot more resilient than we all imagined this time last year. I think if we were having this conversation this day last year, we'd have probably been in a different space. But like the economy has definitely been a bit more resilient than we ever thought. So I think banks as well with IFRS and with provisioning and the coverage that they have, I think they will have different options in terms of the resolution strategies that they have available for them. So I think talk about repurposing NAMA, notwithstanding the fact that we obviously will be here to help, I think is premature at this stage. the one other thing, just maybe to touch on a point around the servicing, is that like obviously we were set up as a commercial real estate asset management company. The focus seems to be on retail and SMEs. Like that will require a different skill set and expertise than that we probably don't really have in-house at this stage. So any repurposing of NAMA would obviously require a different set of skills and also a different set of resolution strategies. So it's something I think that is positive from a European perspective, that they're putting in some groundwork, but I think at this stage it's premature in terms of a European-wide AMC or even a national AMC within Ireland.
Yeah. No, thanks, Jamie. And you mentioned there that the capitalization of the banks, and Declan, I was going to ask you, are you seeing any different approaches this time by banking institutions, given, I think, particularly in an Irish context, their balance sheets are significantly stronger this time compared to the global financial crisis?
Yeah, I think just the wealth of experience over the last decade has really contributed to a development or an evolution in their approach, and it's all about protecting capital and using capital efficiently. The banks have realized that there is a cost to holding on and not resolving NPLs relatively quickly. If you look across to the US, the level of early provisioning, which allows for early resolution, is very different, very much more aggressive than we've seen in Europe. I think the Irish banks have learned that there are benefits from getting out ahead of this early and provisioning appropriately, so that you can move on and focus constantly on your front book, not necessarily your NPL book. So I think the global financial crisis remains fresh in everyone's mind. We're still looking at legacy exposures and resolving legacy exposures, but I think as new exposures emerge through the likes of COVID, I think there may be a much more aggressive and pragmatic approach. We've also seen an evolution in terms of the approach to resolutions. So as I said, we're now at the kind of the back end of the global financial crisis. We're becoming much more creative in the way that we resolve these assets. And if we think about mortgage assets, assuming you're going to be able to repossess an Irish residential property may have been a reasonable assumption, 8 to 10 years ago. I think we've all learned that that's not the way it works. And alternative solutions have emerged and are now viable, and those are the solutions that we're all implementing. A number of service providers have popped up to facilitate that, and ourselves and a number of others work with and fund those solution providers to essentially deliver a better resolution for both the lender and the borrower. So I think if you combine the more efficient use of capital with more creative solutions, I think we'll be out of the next crisis much more quickly than we were able to get out of the last one.
Yeah, maybe I just come in there on that,
yeah,
because that's a very interesting point, Declan, and it's kind of linked to what Keith was saying earlier on around the changes in the securitization regulation. Like what we've seen over the last year or so is a move away from a straight whole loan sale as the be all and the end all in terms of a solution for problematic loans in a number of the financial institutions. Like we acted for a bank towards the end of last year, but I know there's been a couple of similar deals out there where there's been a hybrid solution between a loan sale and a securitization. So what I mean by hybrid is like the whole loan sale, you do a whole loan sale and then you do the buyer would do an immediate securitization of those loans. Now it sounds great, but I mean, there's a different risk, maybe a different risk profile, different allocation of risk. There are a lot of advantages from the sell side, particularly. Like every seller is looking for a clean break. So that gives you a clean break. It means that the seller avoids risk retention. They don't participate in the they don't subsequently originate the securitization. So they avoid risk retention. And then probably more importantly than anything else for sellers is they receive the purchase monies or the purchase price a lot quicker than you would in a normal whole loan sale, where you might have to sign and have a 2 to 3 month period before you get your purchase price. So it's a very interesting structure, and a number of the banks have used them here in Dublin. And I'd be surprised, look, if we don't see more of these types of structures in 2021 and beyond.
Mm-hmm. And you'd mentioned earlier, Neil, the KBC and Ulster Bank announcements. How do you think that's going to impact the market?
I think it's very much a wait and see. There's not a lot of transparency around what's happening with the NPLs. That'll be my takeaway from it. Like, you know, Ulster and KBC would have been sellers of loans traditionally, along with the other banks, and now the other banks are going to be buying those loans. So it's there's a lot of dry powder out there from investment funds. We get asked all the time about opportunities in the market, and you would think there's plenty of opportunities, but really there is a bit of a lack of visibility as to when those loans will actually trade, how much they trade, and what they'll look like, and what the pricing will be like on them. And then what will happen there, that's most of that is the performing piece, and then you've got to look at the NPLs. Do they come along behind it? Do they go ahead of it? It's probably not wise to think that investors are going to sit around for a year or two whilst the performing piece gets done and then come in and deal with the non-performing loans. So it's a tricky one at the minute, and like as I said, that's why I think there's quite a bit of uncertainty around the market, because the sellers that are in the market for buying these, the other Irish banks, are probably stalling their own deleveraging plans at the minute.
Mm-hmm. And Keith, in terms of that loan and securitization interaction that Neil referenced there as well, are there things that you're seeing that people should be aware of in the market too here?
Well, I think, I mean, it touches on something that Declan said as well, is that the nature of the investors coming into the market has developed over time as well. So, I mean, I think that, so going back a little bit, the development of the personal insolvency regime generally has facilitated, I suppose, a greater degree of expertise in the market regarding resolving kind of loans with personal borrowers, and as a part of that, particularly around personal insolvency arrangements and all of that. And then as the initial borrowers have, I suppose, come in, or the initial loan purchasers that would have come in 2013 to 2015 now are wrapping up and pulling out of the market. There's a much more active secondary trade and a diversification of the type of investors coming into the market. So rather than kind of the traditional investor that we would have seen over the last number of years that kind of came in, had a fairly binary policy in terms of trying to enforce and generate as much return as possible, that's beginning to metamorphosize into that model still exists, obviously, but then there's other entrants coming into the market that are willing to kind of work with borrowers to kind of come to a more facilitative resolution that would kind of put borrowers on a reperforming basis rather than necessarily coming in to enforce and dispose of assets. And I think the attraction for that would be from an Irish government perspective, particularly in light of all of the infrastructure that's been put in place to protect particularly SMEs and personal borrowers like the MARP and all of that. It allows new investors to come into the market to be effectively have much better press on entry, to say that, look, our model is different. We're coming in to come to kind of a functional rearrangement of someone's loan with an underlying borrower. We're not looking to kick people out of their homes. You want to work with the underlying borrowers. And I think in terms of particularly the likes of AIB that obviously have a significant state ownership, PTSB as well, it allows, I think, those sorts of institutions more easily disposed to the new investors, where the story is probably more positive from an underlying borrower perspective. So I think in terms of market development, that's an area that we've seen over the last kind of 12 to 18 months that is developing, and my expectation is that more of those sorts of investors will come into the market over the next while.
Yeah. Thanks, Keith. And you mentioned the secondary market there, and I know, Brendan, you had said it earlier as well, that there's more secondary trades as the market matures here. How do you see that developing over the next 12 months?
Yeah, I think the market has matured, and there is a secondary market that has developed as a result, and it's now acceptable. And I think it comes back into what Keith is saying there as well, in terms of the changing or evolving type of solutions and what he's seeing from the purchasers. Definitely on the servicing side, we're seeing a greater shift to that type of evolved model or a change model. So it's generally accepted that there's a longer term solution and a more broader set of solutions available for customers now. And I think that gives, it gives both the primary sellers more confidence in the market and a developing secondary market, somewhat a more specialist market, if you like. So the secondary market is developing because there are specialist solutions available for those particular type of assets or customers. So I think it does dovetail into somewhat maturing and evolving market, Luke.
Yeah.
And
Thanks,
just to build on that, Luke, I was just going to say, the investors, we go out and raise capital, right? And we promise our investors certain types and quality of return. So it takes a bit of time for us to catch up and to be able to participate in these new models as they develop. So we, historically would have had a single strategy focused on acquiring performing and non-performing portfolios of loans. Over the last few years, we've developed a secondary strategy to focus on new lending partnerships with originators. So that allows us to, and those are obviously at two different price points. So that allows us to support kind of, I think, some of what Keith was saying in terms of we can not only buy the whole loans, but we can also then support the reperforming loans. And one example of that is where we're happy to purchase portfolios such as Project Iris, which is a book of non-performing loans from AIB. But we also fund some of the solution providers that provide those mortgage to rent and rental solutions to allow the borrowers to stay in their homes. So we can participate both in the upfront distressed element, but also in the long-term workout as well. And I think that's just good for the market, really, to be able to combine the appropriately priced capital at the right point to get the appropriate solution into the mix. So, and I think we'll see more and more investors who are bringing that appropriately priced capital to the market.
I think, Luke, sorry, just to add to that, like in terms of the seller side and the reputational management, that's all very positive as well, because there's a range of different solutions that are obviously, from a selling perspective, taking the pricing side, but it's obviously giving them a better management of their reputation. So, like, obviously in the early days, people were focusing on the love term in Ireland of vulture funds, and I think the market has evolved and has changed since then, and I think that's a positive development and a sign of our maturity.
Yeah, and Neil, I was going to sort of building on those in terms of what you're seeing to help those trades happen. What sort of things do you see benefit vendors and and help purchasers in those processes? Yeah,
like I think certainly the enablement of Irish loan portfolios has improved tenfold in the last, if you go back to the IBRC trades, 2012, 2013, and you compare that with how books are enabled now by all the sellers, it's like night and day. I think everybody's come to the realization that full enablement process of a portfolio optimizes value. It gives a better allocation of risk. It gives you, on the sell side, it gives you a better visibility to negotiate your warranty package, to know exactly what you have. It has a direct price impact. And I think, the CBI got a lot of criticism, but I think they've done a very good job to try in bringing the standards up to date. I think some of their communiques, like I think the last one might have been the August 2019 letter, sets out their expectations for sellers in selling loans and securitization vehicles. And they've done a very good job in driving that standard forward. I mean, there's also technology has improved massively. In some of the work that we do, we would have a project house and we would have integrated technology and integrated systems with some of the sellers. And that's helped bring everybody up to speed, help the financial institutions have better records. And then it drives that down into the secondary market, because the secondary market is kind of dependent on the information that came out of the primary sales. I think one of the biggest advantages of proper enablement is just around post-sale assistance, remediation undertakings, further assistance, further assurance type clauses. Like you can have once you know your assets really well, and both sides have the ability to diligence them, you can really cut down that remediation offering. Now, sometimes it makes sense and sometimes it works for buyers, but it's back to the same point that we talked about at the start. There's only a small number of people on these deal teams, and you might do a trade today which has a remediation undertaking of X million, and you might have to work on it for 12 months. When the board of that financial institution has to write a check for X million 12 months down the line, it's totally out of context to the deal. And they look at it and go, why are we writing a check for X million when this deal happened? They've forgotten about it. The glow of the deal is long gone, if you know what I mean. So I think, once you have that full remediation, you get a much better clean break from the sell side. And then it also helps the development of a really robust secondary market. That'd be my take on how that's improved over the last sort of 10 years.
Yeah, thanks, Ian. I will just remind the people listening in that you can use the chat function to ask questions as well. I was coming to you, Jamie. I was also going to ask you, is there anything that you would say in terms of recommendations from the numerous loan trades that you did that would benefit vendors or from the process as you saw and led?
First of all, I'd like to just echo what Neil has just said in terms of the understanding the portfolios that you acquired. So back at acquisition, it was an undertaking and a half to try and understand the bank's portfolios. I think we have improved tenfold since then, to be perfectly honest, in terms of banks understanding what they're selling and allowing purchasers to understand what they're buying. So I think that probably has been a key learning in terms of the NAMA scheme and in terms of engagement across the Irish system anyway, that banks needed to improve and have improved on that side. Like a lot of the early lessons, Luke, from a NAMA perspective have probably been resolved. Like if you look at back when we were established, we didn't have IFRS 9. Which has fundamentally changed, I suppose, how banks really deal with their portfolios of NPLs and non-NPLs. And I think the key thing there is, like, I think NPLs have become nearly a normal part of banking. I think pre 2008, non-performing loans nearly weren't an Irish concept. Banks lend money to take back or to get back money, whereas I think there's a recognition that NPLs are just a normal part of banking, and there is a level of NPLs that banks are just going to have to live with, and once it gets above that threshold, banks have to deal with their NPL. So I think that's one of the key lessons. Like data and systems has been key from an NAMA perspective, and the clean break. Like when we were trying to deleverage our portfolio, we obviously wanted a clean break. So we never really, I know the liquidation of IBRC didn't do reps and warranties because they were liquidators. We obviously gave very time limited reps and warranties, but we felt we provided sufficient due diligence in our data rooms to support pricing and to support buyers' understanding of their portfolio. I think that probably has evolved as well since. I think if we were doing those type of loan sales today, we would actually be providing even more due diligence. So I think that the market has evolved, and I think it's taken on board a lot of the early lessons anyway from a NAMA perspective.
Thanks, Jamie. And Keith, is there, in your view, do you think there's anything from a commercial or legal mechanisms that would be beneficial for us to help resolve situations, or do you think Ireland has a strong and robust framework at the moment?
Well, I think the framework in terms of underlying borrower protections, both kind of individuals and SMEs, is pretty strong. I'd nearly say that it's probably too strong, because your ability as an incoming investor to realize the underlying asset is probably more protracted than it would be in other jurisdictions. So that probably puts investors off. So again, in terms of looking at the whole cyclical nature of actually NPLs, in terms of banks getting them off their balance sheets, and then the macroeconomic effect of banks having to hold less capital and more money to lend and all of that sort of stuff, I think some of the underlying borrower protections, while from a policy perspective are good to have, I think from a macroeconomic perspective they may not be optimal. But I do think that the other thing that I think probably needs to change in Ireland and will likely change is the requirement for legal owners of loans to be regulated. I mean, that's effectively at a step with the new credit servicing directive at European level. And I do think that obligation creates a lot of difficulties for incoming loan purchasers, because obviously they're investing hundreds of millions in loans they're acquiring, and then effectively have to step back and let an underlying servicer look after their investment, which, I mean, is generally fine because the servicers in the market are quite sophisticated. But equally, if you have invested a significant amount of capital in the Irish economy and underlying assets, you want to be able to basically direct how those assets are resolved and dealt with. And the restrictions in the credit servicing regime here are probably, well, not probably, but does make that, I think, unnecessarily difficult for loan owners. So I'd say in terms of things to be looked at, I'd say some of the protections around borrowers, although would be unpopular from a political perspective, but I think they could be tweaked a little bit back in favor of lenders. And then in terms of credit servicing, if the requirement to regulate legal owners was removed, I think that would facilitate a little bit more activity in the market in terms of new entrants, at least.
Yeah, and building on that and sort of echoing one of the questions which just has come in, Declan, you also mentioned that there's different strategies to get to value, which plays for both borrowers and lenders. But do you think there is anything policymakers could look at to help the resolution of NPLs in Ireland at the moment?
Yeah, I think there's a change in perspective that's developing, and that's just been happening over time. And I see the two questions we got in, so thanks, Michal and Tom, for those around kind of what we should expect around repossessions. It's culturally inappropriate in Ireland to repossess a residential home, a PDH. But we've seen behavior change. You have a number of adjournments going through the court process, and a judge will essentially give you or give the lender the opportunity to explore all alternatives, and the servicers, rightly so, will try and work with the borrower to explore all alternatives. When you get to the short end of those processes, the judge will say, have you considered mortgage to rent, for example? And if you haven't, you need to, and don't come back here again unless you have. Otherwise, I'll be forced to grant an order for possession. And it's getting to that point in these legal discussions that have given rise to people like us saying, actually, there is a real opportunity here to deliver those solutions at scale and to really help people. So rather than hoping against hope that the market would change quickly and repossessions would be granted and there would be mobility within the existing housing stock and everything would work out, you put your mind to coming up with solutions that will work. So we developed our ability to fund mortgage to rent at scale in Ireland, working with a local provider to do that. We're now working with many providers in the context of the Project Iris portfolio to provide those solutions. But I don't think you would want, for the benefit of the economy, for you to rely only on that. I think it's unfortunate we have a a shortage of residential housing in a number of areas in Ireland currently, which actually makes it quite political to I guess give the green light for repossessions if those repossessed don't really have many alternatives to relocate. But again, the sentiment is changing. I think there was a straw poll that was published earlier today, or at least I heard on the news, where over 50% of the respondents were hoping that repossessions would be granted more quickly in Ireland because they see the knock-on impact to the general mortgage market and home ownership in Ireland. So I think we're evolving. I don't think you'll see any major changes quickly, but I think we're evolving slowly, and there'll be a combination of a more reasonable approach to the treatment of security in a residential setting, but also solutions will continue to be developed and deployed that do preserve home ownership and the ability to stay in your home.
I mean, enforcement rates are laughable in Ireland compared to the rest of Europe. I think one of the studies found that on average you recover about 11% in Ireland versus the European average of about 46%. And in some places like Holland, where they actually trade PDHs online, you have like 90% recovery. So it's I don't think it's sustainable. And ultimately, the hilarious thing is that the same people pay for it all because it keeps coming back to the same point where the consumers pay for the higher rates, and that's who ends up paying for the won't pay versus the can't pay. You know?
Yeah, I mean the element, the value of time in all of this can't be overstated. The time value of money has a huge impact on the underlying value of these portfolios to the sellers. If the expectation is the resolution won't be delivered for a number of years, that's very different than being able to come to a reasonable resolution within a few months. It can be night and day in terms of the pricing they should expect. So it does have a real impact.
I'd just add to that as well, Luke, that the enablement conversation we just had there feeds into that nicely as well in terms of, from a purchaser's perspective, early on in the due diligence, they're beginning to see the solutions more clearly, particularly around those type of problematic PDHs. So they can see they can point towards the various solutions, as Declan said, be it mortgage to rent or private rental scheme. So at least they're not feeding in towards the traditional order for repossession route. So that enablement certainly helps, or the heightened expectations around it. Yeah,
and I think we have a reasonably efficient commercial side. I think I think that personal side is one thing that we have to look at. And one question that has come in, Brendan, as well, is that around the fast changing or developing NPL market requires fast decisions, and do we have the IT solutions that are good enough to support this? What's your perspective on that?
Yeah, I think we do. It's evolving. There's no doubt there's evolving. But I think it is quite good at the moment, and there are some quite good developments in that space. I think ultimately it comes back to more engagement with the customer and dealing with it on a case-by-case basis and finding those solutions for the customer. So I think with the fintech coming into the marketplace as well, I think there is good solutions available there, and it's developing and evolving all the time.
Yeah.
And just to add to that as well, Luke, there are suppliers coming in, feeding into the main services as well with their own specialist IT environments. So with that, to support those unique products they supply.
Yeah. And Keith, sorry.
Yeah, no, the other thing I was going to say, I mean, aside from IT solutions, it's I think with the development of the market over the last number of years, like everybody who is involved in the NPL space, both advisors and sellers and buyers, are much more familiar with the books, much more familiar with the problems, much more familiar with the system. So relative to a number of years ago, where you would have had a lot of examination of multiple issues, that examination has all been done both from a commercial, regulatory, legal and accounting perspective. And so a lot of the trades now, everybody's familiar with the underlying assets, their issues, enforceability, timelines, and so on and so forth. So coupled with kind of a a better IT infrastructure, I think kind of the overall maturing of the market and the players in it facilitate much faster decision making and much more accurate decision making around pricing, even without the requirement to do detailed due diligence that people would have been doing kind of back 2013, 14, 15.
Mm-hmm. And you say that I think, and I agree with you that everybody knows that the assets that are there. Do you think there'll be any change post-COVID, Keith, in terms of the sectors or type of loans or NPLs that may come to the market?
No, I don't think so. I think sectorally it'll be a sectoral issue. Like in terms of it'll be primarily kind of retail and hospitality.
Mm-hmm.
I think, given it'll probably be back to more SME rather than personal loans, I think they're much more easy to deal with, both from a diligence and pricing perspective, and then in terms of the infrastructure around it, like from a legal perspective, the mortgage documentation typically is reasonably robust for higher value loans. So I think back to kind of getting into a more commercial real estate space is something that all of the market participants are very comfortable with and familiar with, and it doesn't have as many kind of tail complications that the more kind of personal borrowings would have had. So I think it's probably an easier it's an easier path in the commercial real estate space than it is in the personal space.
Yeah, and I think building on a comment, I think it either came from Neil or Keith earlier in the conversation, it'll be interesting to see now post-COVID whether we see the restructuring capital playing a primary role with what would otherwise be going concern businesses that can be saved and propelled into the future, or whether we see people deciding that these are not going concerns and you switch then very quickly into a non-performing loan scenario where the real estate is the key asset. That's going to be key now as kind of the winners and losers are sorted out post-COVID. Hopefully it's more of the former for the sake of the economy, but it'll be interesting to see.
Yeah. And I think building on that, Neil, and what we might see, do you see a lot of the trades in Ireland have been on the secured basis? They're in terms of the underlying collateral, there has been some unsecured trades, and one of the questions is around that. Have you seen any evidence of more unsecured books coming to market or similar types?
I would have acted on a few unsecured loans, but probably post-enforced is probably the best way to describe them. Loan books in the past. The question is around pricing. I don't price loans, so I don't know, but I'm not sure there will be more, because most of the Irish lending is done on a secured basis. And we've just talked about how hard it is to realise your security in Ireland. So the onward scale of those loans, unless, and obviously the institutional banks here don't do solutions that the likes of LCM can do or Everyday can do. So I'm not sure I would see it, but I'd be interested in Declan or Brendan's view on that.
Yeah, I think the unsecured market has held up very, very well during this COVID. I think it's propped obviously from the government supports. So what's going to be interesting is that as that unwinds, as I said earlier, and the timing of that unwinds, I think we're going to see challenges. I don't think the challenges will come necessarily from the secured space. I think asset values have held up relatively well this time around. We're seeing a lot of new lenders, specialist lenders, non-bank lenders for a refi in the market and those particular types of assets. I think the issue is going to be around the unsecured space, and particularly around the SME and personal loans for me going forward.
Yeah, I think, in terms of kind of how the valuation of that, how we would think of that, it's really around certainty or lack of certainty. So if you're looking at coming out of a period of COVID supports and you're unclear on how that will impact the future cash flow on an unsecured portfolio, that's going to be reflected in the price. So, probably not the best idea to be selling unsecured now with that given that level of uncertainty, because you will achieve a lower price as we get more certainty around the performance of those distressed borrowers, you will obviously be able to pay a higher price.
Yeah, I like one thing we are seeing is the use of Irish Section 110 vehicles to acquire portfolios throughout mainly Europe, so Spain, Italy, Greece. The Irish, for all the discussions we've had about the repossession time and etc. and the difficulties in enforcing residential loans internationally, the Irish market is seen as a very sort of stable and robust market, and the Section 110 vehicle provides investors real tax efficiency in that regard. So we've seen an awful lot of Spanish portfolios acquired through Section 110 vehicles, Irish vehicles.
And do you expect that to continue, Neil, across the different portfolios as potentially other European markets, NPLs may be greater?
Yeah, I think so. When investors came to Ireland initially, like we were seen as a stable, predictable regime with a transparent court and English speaking. So I provided the tax efficiency remains with Section 110s, I don't see how or why there would be a kind of a move away from that. In fact, I'd probably see an increase in it.
Mm-hmm.
Yeah, it goes beyond Section 110s as well. I mean, we're LCM Partners is a London-based investment manager, but part of a larger group which is domiciled in Ireland, has an Irish servicing company, and we have over 900 people across Europe working on our strategy, all kind of ultimately owned by an Irish group. So we have our own Section 110 companies in Ireland as part of that investment strategy, and all of that works very well together.
Mm-hmm. Yeah. And then I suppose just very conscious of time, and we're coming close to the top of the hour. So maybe if I ask you all, to get out the crystal ball, and maybe start with you, Jamie, in terms of how do you think activity will happen over the next 12 months?
Just in terms of COVID-related NPL, I think it will be wait and see. I think it'll be 2022 at the earliest. Yeah. I think anyone might see some small targeted sales of smaller loan portfolios, maybe reacting to some of the structural changes that's been brought about by COVID. I think some of the Irish banks, to the extent that they have capacity to engage with KBC, Ulster Bank, some may continue to do some of the securitization type transactions that they've been doing anyway this year. And I think the one observation I have, just in something that Declan said earlier in terms of SME lending, is this identification of viable versus unviable businesses. Just in terms of viable businesses, I think it's the time that those viable businesses may need to turn around. So, you have this talk of 5 to 7 years for some of those businesses, even if they are going concern. I suppose the question I have from a banking perspective is, can the bank support those firms for that length of time, even within their own structure, and will that drive some other activity next year?
Yeah, with their capital hold. Keith, your perspectives?
I think the market is actually quite complex now at the moment, between the fallout of COVID, KBC exiting, Ulster Bank exiting, how all of those elements are going to be dealt with. I think is going to be very challenging, both from a commercial and policy perspective. So I think, to echo Jamie's point, I think the Irish banking market and the NPL space has got such a significant amount of change at this particular point in time that I think everyone will need a little bit of time just to figure out what they're doing, and then capacity issues between the banks, the bank teams, various advisors, investors, to look at the market as a whole, to try and determine kind of where they're going to deploy capital, and all of that, I think are big issues that will affect how the NPL space will kind of operate over the next little while. So I think it's probably back end of this year, early 2022, before that picture becomes a little clearer.
Yeah. And Brendan, do you have any different views or?
No, I think generally, we're operating in a very positive environment. I mean, there's very good visibility between the sellers and the buyers right now. I think the Ulster Bank and KBC exit from the market will distort the market in the short term, and the timing of the release of those NPLs to the market is going to be important. But generally, I think it's going to be 2022 before we understand the full impact of the current crisis and what implications it has on the NPL market.
Yeah, and Declan?
I mean, I think, we've heard, I think there'll be a few jumbo sales coming as a result of the withdrawal and the final cleanups from the global financial crisis. But more and more, it will be about banks' kind of efficient use of capital. Mm-hmm. And that's through the cycle management of the normal emergence of non-performing loans from an ordinary lending business. People like ourselves are well positioned to deploy capital through the cycle to help banks manage that. It's just a piece of their business and a piece of their efficient use of capital. They're also well positioned to continue to own the customer, but maybe not always the best provider of capital to those customers. So I think more and more we might see the banks teaming up with other providers of capital to deliver the right solution to their customers. Who may have more appropriately priced capital based on different capital requirements. So I think we'll see, both ends, the lending and the resolution side, a focus on the efficient use of capital, and that will give us all a lot to do.
Yeah, thanks. And to finish, Neil.
I agree with all of the above. I think the point Declan's just made around balance sheet management is a very pertinent one. I think there's a lot of opportunity in the next 12 months. And I think the only other thing that really hasn't been mentioned is a lot of the acquirers of loans that have had a securitization exit are starting to mature. So there's a lot of secondary trades coming in the next 12 months, which I think will help kind of bolster the market whilst we wait for the bigger jumbo trades out of Ulster Bank and KBC.
Okay, well, if there are any unanswered questions or views that people want to pick up, please send the questions into Smith Novak or contact one of the panelists directly. I have to admit, I find that very informative and an interesting conversation. I hope that everyone did too. I would like to thank Smith Novak for hosting and leading this Irish NPL conversation. Our lead sponsor, Mason Hayes and Curran, who their report was available alongside the invite to this as well, and our sponsor, Dylan Eustace, for your support. And please, a big thank you to our panel, NAMA's Jamie Burke, Everyday Finance's Brendan Keogh, Declan Reid from LCM Partners, and Keith Robinson from Dylan Eustace, and Neil Campbell from Mason Hayes and Curran. I really appreciate your insight and perspective. So thank you and goodbye, everyone.
Thanks, Luke, for chairing so well.
Thanks, Luke.